Happy Tuesday. I'm like completely off schedule today and have been for the last couple months. I'm Trisha Turner. This is Walk Away Wealthy, normally on at 12 o'clock, and we're running a little bit late today. But you know what? Last week, I think we even skipped it all together. So this is not good for consistency and self-discipline, but it is what it is, right? We got a lot going on. And I've got these two characters with me today that are really good friends of mine. They are our preferred lenders. We absolutely love them, and they're the reason that we're late.
Oh, it is. We are not the reason.
This is Scott Middleton and Jared White, and I want you guys, or you guys in the real estate world that pay attention and tune in, I want Scott and Jared to let you know, where they are in the world, what they do for a living, their company name, and kind of a little bit of their backstory. One of y'all jump in.
All right.
Go ahead, Jared.
Well, we're with American Financial Network. We do all residential mortgage business, mortgage loans from A to Z, everything other than raw land is what we tell people. So single wide, down payment assistance, jumbo loans, construction loans, pretty much all the non-QM loans like bank statement loans or no doc loans, I-10 loans. So pretty much everything under the sun other than raw land, which we outsource those out as well. So, and like a HELOC loan, which is a bank product, but everything else we do. And we also do, we do a lot of the, not credit repair, but Trisha, you know this, we don't turn anyone away no matter what they look like. We want to give them hope. We want to give them a plan. And if they can take that advice, then we typically will get them into a home or ready to get into a home.
Well, let's just be honest. We close hard loans.
You do.
We like easy loans too. But we do
for you all. Yeah, like you guys, they closed one of our hardest deals in probably my entire career. I don't know, like 2 weeks ago. And this buyer was definitely a challenge from go. And y'all never gave up. We never quit. Like none of us did. It was a group effort. And I know we would not have gotten to the closing table without you guys being involved in it. So boom for y'all for just definitely thank you.
Yeah.
Yes.
We like to tell people we will die with a loan. Like we're going to go down swinging. We will fight an underwriter, anyone in our way to get it to the finish line. And that is something that I think Scott and I both really do take pride in. Is we will close loans that no one else wants to touch because they're hard or they don't think they can close, and we take it as a personal challenge when we get them. Now, having said that, we don't want all that business either. We like the good loans too because we like to sleep at night sometimes. But yeah, we do. It's something that he and I, since I've met Scott, it's just we have the same drive when it comes to that source of business, and because we know it leads to relationships that we grow, and it leads to other loans. Like you might send us a loan that's a difficult one, and the next one might be a slam dunk. We got a slam dunk we never would have had. So. But that's just what we do, and we'll always do that, hopefully. So,
I mean, my deal with that has always been the same. You can take somebody that is a jumbo, a $2 million purchase with 30% down, 800 FICO, many reserves. They know more than likely they can go on the market and get a loan from anyone.
Yeah,
it's a decent referral partner for the agent. You close somebody that's been told no, that agent's going to get referrals from every single family, every single person. You're going to get flooded with business.
Yep. I know that we've got people that have closed loans with you guys and they've been told no 6-7 times from other people. So again, and you guys are like the real deal. That's why we're going to grow our business like crazy with y'all. Lots to come. Y'all need to pay attention to that. But today we're going to talk about all this stuff that's all over the media that went into effect May 1st regarding lending. And like people are really confused. Is my credit, does it matter if I pay my bills now? Because I think the good people with good credit are the ones being hurt. That's the rumors. Or is it the people with bad credit who pay more? Can y'all kind of like break down what went into effect May 1st and what differentiates that? What are we looking at? What's the real deal?
Yeah. So, and being honest, like as far as we'll talk about, it's basically a loan level price adjustment. They say you hear the people. I've heard a few realtors ask me, "What's the LLPA?" It's kind of shocking to hear that because I've never heard a realtor even mentioned LLPA before, and it just stands for loan level price adjustment. And all that is a Fannie Mae and a Freddie Mac, who every loan is underwritten to on the conventional side. It's their risk-based pricing on a loan, meaning, the lower the credit, the higher the risk level, the less money down, the higher the risk level, the lower the credit, the less money down, the higher the risk level. An investment property, a secondary home, the higher the risk level. And they've added in price adjustments into those certain boxes. Like if you have a 660 score with 5% down, the loan level price adjustment is very high. It might be 2.5 points, not in price to the borrower, but the pricing is what determines the borrower's rate on a conventional loan. So the more price adjustments, the more price hits that are affected by that LLPA, the higher the rate they're going to get and the higher the costs are going to get for that rate at closing. So it's really going to affect them if they have a low credit score or low down payment, or if they're doing an investment property or a secondary home. It's a whole matrix that you look at, and it's a grid, and it spreads out basically off of credit scores and down payment and loan to values. And that really affects it. So the rule that went into effect May 1st, and I still have yet to see it into the price. I don't see an LLPA hit for a 680 plus borrower, which is what's advertising out there. It might be built into the pricing, but I haven't seen an LLPA that says if you're a 720, you got a 1.75 hit to your pricing because you've done well your whole life and paid your bills. I haven't seen that yet, but supposedly that's into effect. And what that is, what it's been described to us is it's a subsidy that goes into a pool basically, and that's used to pay on the people below. It's supposed to benefit them, and I still have yet to see the benefit in the pricing or a scenario yet.
It just, like we got calls where my credit score should be lower so I can get a better deal. That was a big thing we kept hearing over and over. And LLPAs, it's something you can Google. It's not like hidden by the lenders. It's out in the open. But you take a 5% down loan with somebody that has a 640 credit score, and their rate hit is 1.5%. Same loan, if you're at 780, your rate hit is 0.125. So it's not, that's crazy to think that way, because it's not, you're still taking a rate hit enormously for lower credit. It's not better. It's in fact, it's a little worse as far as I'm concerned, because go
ahead.
Because what they've done is they've saturated the market with all these misconceptions. It's no different than you talk to your uncle, and your uncle tells you that the world's going to collapse in 2 weeks, not to buy a home because rates are high. But yet your uncle bought a home, and his interest rate when he first bought it was 11%. It's just all these misconceptions out there that's confusing to the everyday run-of-the-mill borrower.
So then is it safe to say that if someone had like a 620 credit score and the same property, someone came in with a 720 credit score, big difference in rate then?
Enormous.
Yeah. Okay. And not only that, Tricia, like the people saying I shouldn't do well with my credit, well, you stand a much better chance of still getting approved if you have a good credit score, because the system picks up on that. Again, the reason these LLPAs are in place, it's essentially risk-based pricing. So these loans they look at the performance on them, and how they perform in the market. And the reason, like an investment property, a secondary home, the price hits on those are over 4%, for putting 20% down. So 4 1/8 is the price hit if you're putting 20% down. It's 3 1/8 or 3 3/8 if you're putting down 25%. It goes down to 1.125 if you're putting down 30%, basically. So
that's huge.
Yeah, it's enormous. And those, up until COVID hit, the second homes were priced just like primary homes. There was really no difference in pricing, but because of COVID hit, people lost their jobs. People, whatever happened, people started missing payments. These homes start performing worse, and when that starts happening, they go and they make these adjustments, and they'll improve again maybe when the market turns back and the world gets back to normal, hopefully. But for now, this is what's in place. That's why secondary homes and investment homes, they're just, the rate's going to be 2% higher than the market, and they're going to pay 2 to 3 points for that crappy rate, because the prices are so great. So
when you're talking about points, so consumers understand that, is that something they're going to pay in closing costs? So that increases.
Absolutely.
It's a discount point.
1 point on a $400,000 loan is $4,000.
Okay.
And they're getting charged 2 to 3 points on those loans. So do the math. It gets real pricey, which is why we always try to get seller concessions if we can. I mean, we're getting them on almost every con. Now I know it's starting to go back to the seller side in some markets, but we're getting probably 7 to 10 grand on almost every contract. We're like asked for, especially the lower FICO people, the FHA. They got to have these seller concessions because these points are so great that they can't afford the closing costs and the down payment. They can barely afford the down payment, most of them.
No. And so like when I'm listening to you, what I'm thinking right away is like, why on earth would that be put in place? Because it's going to put a halt to so many people that are able to buy.
It already has. That's why the lower FICO loans currently, they're almost impossible to close if we don't get seller concessions, because they can't. If you think it's somebody that normal run of the mill, someone that has a 620, they don't have 40 grand sitting in the bank. No. They've got 2 months closing reserves. They're coming to the closing table. If it's a down payment assistant loan with no money, like we're stretching these thin. And so when you're charging them 2 points for their rate, now their closing costs are $8,000, you can't outrun it. And so that's where relationships in this business matter so much, because we're constantly communicating with their agent. Hey, we got to have XYZ to close this loan. And a lot of times consumers think that if we charge them 2 points, like that's what me and Jared make. It has nothing to do with anything we do. It's how we're going to get the loan to close. It's not we charge a point. We don't get to keep that point. Like that's not they're literally getting charged for that just for their rate.
It's a true discount. So it's a true dollar for dollar, dime for dime cost. Whatever is charged on discount is the cost for that rate. Those are audited. So we can't, like Scott said, we don't pocket discount points. That's a true buy down of the rate. So, that is due strictly to their credit score and pricing.
Which is just insanity. So then when I'm like future casting in my head, I'm like, okay, if the market shifts in the next 30, 60 days and we start selling more homes, and when things pick up a little bit, and of course sellers then are not going to be willing to give concessions as much as they are right now, that could be a real problem for buyers. Crazy. Like none of that even makes sense.
100%. The 640 and below buyers are going to push them out of the market.
Yeah.
No, it's just a strategic way for them to get pushed away. And if you watch government's way to push those borrowers, because they don't want to take the risk.
Yeah.
So they just stop doing the loans. They don't tell you we're going to stop. They're going to say, no, if you got to, our guidelines haven't changed. If the minimum score on an FHA loan is 500, well, that's great to say that, but can the loan get approved? And can you close it? Just because it says you can do it doesn't mean that we're going to close it. And so they make it harder on the back end to close those loans. But absolutely will push those borrowers out.
So you mentioned FHA. Okay, so is this a new LLPA pricing adjustment thing? Is this only for conventional, or is it FHA loans as well?
We've seen the adjustment on FHA. Now, I don't know where to go look, and this might be something that we could do. But most of the time, Fannie and Freddie will follow the FHA, so it's not a drastic difference. FHA is still going to have rate hits, and they're still going to, an FHA loan with a 750 borrower, you're going to run that DTI to 56. They're not going to get charged points. So on a same scenario, a 600 borrower, you're going to have to charge them points for the rate. It's going to be higher. And you're going to have to get the DTI down because, like I said, a year ago, we could close those with high DTI. Now it's harder to run through the system. So the price adjustments are 100% there.
And when you read, you'll see reports, I read something the other day about everything's 2 or 3 months behind. February, March, they went in, they tightened credit standards up for FHA, for loans we've always been able to get approved in the past. I've done it 20 years. A 700 borrower, 5% down with decent DTI in the low 40s. was approved every single time. We've struggled to get some of those approved. Can't figure out how to get them approved. There's the systems, Fannie and Freddie, FHA, VA, they've tightened it up to where there's certain things on credit reports, certain things with the reserves. Credit history is definitely the last 12, 24 months matters. So they really notched it down to where it's harder for those people to get approved, the better borrowers. The lower borrowers, it's below 620 to 600 and 580. I mean, we're scratching our heads. Like, we have an approval, we enter seller concessions, and now we don't. That's the only thing we're changing in there. So it's little things like that we're we're playing it by ear and figuring it out as we go. But again, we try to encourage all of our realtor partners to please, before you write an offer, ask us what the borrower is going to need. Are they going to need closing costs? Because to me, that's one of the most important things.
It is.
A lot of realtors are just afraid to ask because what we went through 2 years ago when it was a hot market, they couldn't ask. And now they're still afraid to ask. And these borrowers aren't going to close without it. So you might as well ask. That's my point. We got to have it.
And I think everybody is just like it's the analogy, when that fire is hot and you touch it, it burns you. And that's what happened during COVID. Like, the house is listed for 200, it's selling for 250. Like, I can't ask for closing cost. Well, I mean, I had one 2 weeks ago where I literally just sent an email to the listing agent and was like, hey man, we're going to need XYZ to close this. And she's like, well, the buyer's agent didn't even ask. We would have gave it. And it's like, gosh dang it. She's like, if that's what you need to close the loan, Middleton, let's do it. I want this house to sell, and the listing agent is, the sellers are happy with it. They're walking away with as much money as they want. So we 100% see that more often. People are just scared. Like, dude, ask for $5,000. The worst thing they can say is no.
Right.
We have agents still pushing back, like, man, I don't know, and I can't ask. And it's like, dude, you're representing the buyer. Go for it. We can't close the loan without it. We need it. You know what I mean? We're not asking for something we don't need.
I think it comes down, a lot of things, but because it's changing so much and educating the consumers and clearly the real estate agents is super important right now. I want to talk a little bit, like when you just said, Jared, about banks tightening up their guidelines and, for some reason, this 700 buyer, you can't get them approved. Like, what the hell's going on? I remember, and you will too, Jared and Scott, like in 2008 when everything crashed and all these things changed. If you remember, 2009 was like nobody was getting a loan. I don't care what your score was. Like, all of a sudden you got an acceptance, and then maybe a week or two before closing, all of a sudden they decided, nah, actually we're denying the loan. Are you kind of seeing weird stuff like that right now where things are just getting denied for no reason?
Yes. And from our perspective, it sends us in spin out because we'll submit a loan, and this is a simple process. It's running, every lender uses Fannie and Freddie. That's how you run DU or you run LP. Like, that's how you send a pre-approval essentially. And we'll go through the loan. We've had one 2 weeks ago where we literally didn't change anything. And on the clear to close, the underwriter, that's the last thing they do is run it, for the CTC. And she emailed us and was in a panic. And she's like, I've changed nothing in this loan and it's not running anymore. And it's like, what has happened? And what we did on that one, I believe, is we scrambled, went in and placed a second lien. So their LTV was no longer 80, it was 60, and the loan ran. And nobody could understand what was going on. I mean, we didn't change the insurance. That's a big one. As we move through the loan, we might have a quote in there of 175 and it's 200. And as crazy as that sounds, that $25 throw the DTI off or something changes. On this one, it literally, none of the numbers changed. None of the reserves changed. Nothing changed on the loan. It was literally, they were just CTCing it. And I'm like, it sent the underwriter in a little bit of panic. Like, what has happened here?
So you basically had to make a override.
Yeah. And that's where we come into play a lot of times because we know how to fix these things. That agent, that buyer, nobody even knew that we were basically in mass hysteria 10 days before closing, because that's the worst thing you can do is, we're moved through the loan. We've got the appraisal. We're done here. We've sourced everything. Like, we're submitting the clear to close 10 days before closing so we can pull the verification of employment so we don't CTC it and then have to go back. And it wasn't running, and it's just like, that's the stuff that keeps us up late at night. It got fixed and we still closed the loan, but for that 24 hours, it was a nerve-wracking situation.
I think this is harder, Trisha, like this period. Honestly, 08 was a blip on the radar to me. Like it came, we saw it like overnight, no one saw it coming, then boom, everything fell apart. Everything stopped for 3 to 4, 5, 6 months. Stopped. Yeah. Our pipelines died. Nothing closed. And then it slowly started getting back. The guidelines and everything just necessarily didn't change. Remember, subprime went away. That was and that was a big chunk of the market right there. And then we switched more to FHA and all these things. It's just different now. This is more like, we don't know. There's been no announcement. There's been no clear reason why these things are happening. We're in a loan that's always run, and now it's not. And then, like I said, 2 months from now, we're going to report that, they tightened credit standards in May. Again, and we don't know that. They don't announce that this is what the change was. We're in loans, and like Scott said, the key to every loan, no matter what kind it is you run it through the underwriting system. It links up to FHA, VA, Fannie, Freddie, whatever, and your whole approval starts at the very beginning of that and takes it all the way to the end. That's what an underwriter uses. So we're basing it on that, and that's what has changed is within those systems, within those scorecards of the government loans, they tighten it up so much, and there's really no clear explanation of what is going to work and what's not. It's just, like he said, dollars make a difference. An insurance policy or buying the rate down a little bit further or doing something, and the system will read it and it likes it, or it read it and it won't. And it's just, we have to figure out how to overcome those things within the loan right now. And that's the hardest part. Is we're adjusting on the fly so much, trying to figure things out when we had an approved loan at the beginning, and then something changed 2 weeks in the process, and now so we don't. And we're not telling everyone what's going on. Right. So we're like, oh, hell, we got to fix this. And we do, but it's just not easy.
Right? It honestly goes back to what we first originally talked to. Trisha, we've actually worked for companies, for certain mortgage banks that literally called me and Jared and told us, why do you guys close these hard loans? Go get better business. You shouldn't be focusing on this. Well, one of the bigger advantages that we have is because we have a history of doing this. So we know how to get in the system and fix the loan. That doesn't come from just closing pretty loans. Mm-hmm. That comes from doing hard loans and knowing how to fix and going in and getting the loan to the closing table. We wouldn't absolutely be in a bad spot right now if we didn't close what we have for the last 5 years.
For sure.
When we talk to lenders, we talked to one yesterday who literally called us that was closing $60 million a year 2 years ago. And he's closed $3 million year to date right now. Wow. And he's struggling. And I'm, of course, courteous and nice, but he's one of the ones. It's like, yeah, you made fun of us for closing this 550 VA loan, but now that your business is gone, you don't know how to overcome the problems on the loan, and your wheels are spinning. And that's where we're taking a huge market share right now, because all these people that have been told no and they can't get the loan approved, well, it takes me and Jared 5 minutes sometimes. Like, this needs moved here. Let's check this box. Let's get a verification of rent. We're done here. And we're getting a lot of turn-down business right now from builder lenders, because they, the builder lenders, they don't know. And there'll come a point where these, like Jared says, everyone will catch up to us probably in a year or two. They'll struggle through some loans and learn some things, but it's all education. It's, what does Fannie, are you scared to call HUD? Me and Jared call HUD probably twice a week. Will this work? Is this the guideline? Because the guidelines are written and they're very gray. And HUD's great. They'll be like, yeah, get us that. That's an insurable loan. Then we take that information, go to the underwriter. Hey, we've got it. Here's the plan. And there's lenders out there that I personally know that have been in this business 15 years, never called HUD, never have called the VA direct line for the veteran to say, hey, here's the situation. There isn't an exact guideline for this. Help us get this veteran in the home. And they'll tell you, go get 2 months of bank statements or go get this. And I've sent HUD and the VA direct line out to more lenders that I know in the last 6 months than I ever have in my career.
And they send you they'll send you a voicemail, they'll send you the email with the documentation that you need so we can send it to our underwriter going, hey, you were wrong, we can do this. This is from HUD directly. And we just closed a buddy of mine's loan just like that. Tell them the underwriter's like, no, you have to have this. I'm like, no, we don't. We've closed loans like this. I called HUD, sent them the voicemail on email and sent them the guideline they sent me and they took it and we closed it. And that's just, so like I said, we'll fight if we believe that we're right. And Scott, well, Scott reads these are guidelines. He's got them on his desk. That's back here reading guidelines every day, and we're trying to figure out a loan. And that's just really, like I said, it's just knowledge. I tell people it's years of making mistakes. 10 years in this business, I know what the hell I was doing. The last 10 years, I got pretty good. Yeah. It's just, all these challenges we've been thrown at us, we just took them on. We didn't turn them away. And that's how we learn to overcome all these obstacles. And we'll lose a week of sleep on a loan. Can't figure it out. All of a sudden, boom, the idea comes to us. We don't understand. We don't give up on it. I can count on one hand the number of loans we've denied in probably the last 5 years.
Which is crazy.
On. So we really take pride when we send that pre-approval up front. We believe 100% this thing's going to close. And if we're iffy on it, we're going to tell you in the beginning, hey, we're right with you on this, but this thing's got a lot of hair on it. You ready to go? And that's kind of like, we're not going to leave you hanging on that. And if we make a mistake, he and I will be the first one to call you, tell you, hey, we screwed this up. We're going to try to fix it, because we screw up. It's just there's a lot of moving parts that people don't realize that goes on. Once we get an application, it looks pretty. We get into the process and we start peeling back layers. You would be amazed at some of the things we find out, and we had no idea. It's just we have to figure out how to overcome on the fly. So
I think it's you guys aren't afraid to do the work and the hard work, and again, it's like y'all are changing lives because you're giving hope to people that have been told no or many times no. And without you guys, they wouldn't have that American dream of homeownership. I think it's freaking cool as crap. Well, I want to talk a little bit too about down payment assistance because now we're talking about numbers, like you said, well, someone's going to have to pay an extra $4,000 just to get their rate where they can actually get into a house on top of their closing costs, on top of their down payment. Like, how can we make this all happen? And people don't know about down payment assistance. Can we talk about that a little bit, guys?
Yeah. So there's several DPA loans, and what we call them is grants in the state of Texas. In fact, the state of Texas, I would say, because I close loans in other states, they do a tremendous job like getting people into homes. It's unlike any place anywhere else, as far as I know. So you take a down payment assistance loan. Let's say that they have a 620 score. You're going to do an FHA loan with them, which is the minimum 3.5%. We can go get them a DPA or a grant at 5%. We use the 3.5% for their down payment. We'll use the other 1.5% to help with their closing costs. If we get some seller concessions on that loan, they're literally going to walk to the table with no money. They're going to just sign their name. And those loans they're good loans. They've been around forever. We've done them forever. There's lenders out there that don't do DPA loans.
Yeah.
There's companies we've worked with that don't want to do them, but me and Jared have always dug in. And the reason why they don't like the DPA loans, because there's not a lot of money for the mortgage bank in those loans. You're closing those loans at a cost, essentially.
Okay.
So what that basically means is the company's not making any money off this loan you're about ready to close. We're all in a business. You know what that's like, Tricia. Yeah. So does everybody. Like, not to beat around the bush, but you're in business to make money for EXP. Like, it's great that you're making money too, but at the bottom line, if you're not making money for EXP, they don't like you.
Yeah.
And if we don't make money for EFN, they don't like us.
Right.
It's no different. And so those loans, those DPA loans, are kind of an even keel. So you see brokers, I mean, we've met with people that don't close them. We'll get referrals because that lender doesn't do them.
Yeah.
And my feeling with those DPA loans has always been the same. They're door openers. If you're trying to make money on a down payment assistant loan, quite frankly, you're not looking at the big picture. Those loans lead to other loans and they
For
lead
sure.
to other referral partners. But if they're structured correctly, and we've got an agent that knows what we're trying to do and has closed several with us, they know exactly what we need for closing costs. And those borrowers are literally going to the closing table at title and they're signing. We can get them dialed in enough to where we can get their appraisal back, which means they're getting, not only are they not paying anything at closing, they're getting a check back at closing.
Which is crazy.
Yes.
Yeah.
And so, and they don't ever take those away. What they'll do is, T-Shack is another one that's big in Texas. Well, T-Shack might only have a 3% DPA, and then next week they'll have a 5% one. So they kind of go in and out, but there's always something available. There has been. And what we do is when we know there's going to be a DPA, we use e-housing, Chinoa, and T-Shack. Those are kind of the three main ones that we use. And all we simply do is go in there and check the rates because the lenders don't set the rates for DPA loans.
Okay.
That DPA source sets them. So whether you've got a 680 or a 720, you're getting the same rate. Credit doesn't come involved with rate with DPA loans. We'll go in there and check the rates, check what they can get currently, and then that's the DPA that we choose. There's income limits on some. There's DTI restrictions on some. But essentially, if you've got a 600 FICO, there's a DPA out there for you. We just got to find it. And we still do DPA loans on VA. And VA loans are super. But guess what? If that VA guy is not going to be able to get closing costs and he wants to do a zero money down VA loan like most of them want to do, the money's got to come from somewhere.
Yeah.
So you can DPA those VA guys, give them 5%, and they can use that towards closing.
Yep.
And, they're still at zero and the agent is not getting any closing costs in that example. So we can go out in the market and get that closing cost paid for the veteran. It's all about the structure and what you need to close the loan, essentially.
Which is crazy. Like I'm listening to all that you're saying. I hope everyone out there is listening. I hope you guys are taking notes because this is like for real. There's a lot of people that are struggling financially and that's going to continue for a bit. Things sometimes get, worse before they get better. Here's down payment assistance that people don't really know about. I think there's this misnomer too, that it kind of labels you as, people are prideful and they're like, oh, I don't want to apply for down payment assistance. Why?
Well, that's the thing too, as far as that's concerned, when you're writing the contract and you're an agent, it's just an FHA loan. Nobody knows there's a DPA involved most of the time until we send the funds to title.
Okay.
Like it's no different than if you're writing a VA. We just did this one last week. So the builder lender couldn't get this veteran approved because they weren't going to give them any closing costs.
Yep.
And the cash to close was too much. We take that loan, we get them a 3% DPA. Now they've got their closing cost. Now they're going to still sign with zero money and we're closing the loan next week. It literally, that one was that easy. But nobody knows that. Like you tell the veteran or you tell the client, here's what we're going to do because there's paperwork involved, like tax returns, certain items. But as far as the agent, the seller, nobody knows that information. Unless we share it. If you tell me, Trisha, hey, we've got this loan, how can we structure it? And I say, hey, it's going to be a 600 FICO DPA loan, so we need closing costs for what you're still writing an FHA contract. I mean, on paper, it looks no different.
Yeah.
And for the buyers, there's no shame in that. I would have loved when I was young and making $15 an hour and someone would have came to me and told me, hey, Scott, you don't have to save 10 grand to buy this house. Right. We would have bought a home, our second home, probably when I was 23. I mean, I didn't know it was available.
Yeah. And I think most people they don't talk about it. I don't know why. Like, we definitely are talking about this today. Like, as we are moving through all of this, like, number one, housing has got to pick up because it fuels our economy. So when home sales are down, a lot of people are having a problem. A lot of families are struggling for that. And so as real estate agents, like, we got to be thinking like better. We have to be doing better for the consumer. How do we get these people in a house? Everybody's frozen by the rate. Like, I'm not going to buy now because the rate's too high. But there's solutions. Just nobody wants to do the extra legwork, and it's just laziness.
Yes.
And we're going to give them options because, like, within the DPA, there's two options, typically, like forgivable, non-forgivable, and they don't. If they qualify for forgivable, meaning they don't have to repay the bond, we're going to go that. But lately, it's been mostly, non-forgivable, meaning it's a repayable bond. They got to repay it, But and even then, if they have their own money, we're going to show them, hey, look, we can get you this bond. But if a lot of times, if they have their own money, they can get a gift. That's a better option for them too, because then they're going to get a much better rate cost. They can refinance whenever they want. They get locked into the bond. Sometimes they're stuck in it for a short period. They can't refinance or without paying the penalty. So it's just options. We're never going to turn them away from the bond or try to get them into another loan. We're going to give them, hey, here's options A, B, and C. Here's what we can do. And like Scott said, we actually have one of the great things with AFN is we have our own in-house bond program that goes down to a 600 score. Most of them are 620, 640, like TDHCA and TSHAC, and there's no income limits on it, and that's key because a lot of people make too much money for the bond. It's usually like, hey, I need down payment assistance. Well, you made 130 grand, which I'd rather make 130 grand than 80 grand and get a bond, but that is what we do. Is like you make too much money, but now we have a solution for that if they qualify. And again, then it comes down to, does the system approve them if they have low credit? Getting free gift with no skin in the game because the system likes to see they have some skin in the game, or they have reserves. Like a 401k could mean the difference of a loan getting approved or not approved. They're not using it for closing, but the system reads they got $52,000 in 401k, which is 18 months of reserves. Now the loan's going to approve because it shows they got something to fall back on.
We had a denial 2 months ago. Literally, the lender just didn't ask for their 401k account. We put the 401k account in there and the loan. We closed it in like 16 days. The appraisal was already done. It's just that engaging question. And it's amazing to us. I mean, you look on someone's paycheck, you can see they're putting money in their 401k.
Yeah.
They literally forgot to ask that question. Send us your 401k. And the client was like, it's funny sometimes because that client was like, well, Billy didn't ask me for that. Why do you need it? And, they kind of get offensive a little bit in there sometimes, like, why are you asking me for all this information that the other lender? And I always just say, well, one, the other lender didn't close you. And two, we're not going to use this money or ask you to withdraw it, but it helps assets on the loan.
Yeah.
It's a big deal.
I think, like, overall, just I'm listening to everything that you guys are saying. It's like, it's so important. And the real estate side too, that you got to pay attention to who you're paying attention to, because there's some idiots out there doing lending and some idiots out there saying they're real estate agents. They're licensed, but they have no brain. And you can't be partnered up with people like that right now. We're not in that kind of a market where anything goes. It doesn't.
No, I've said it. I've said this 1,000 times. People have no idea how important the real estate agent is. They think that these agents are just walking the streets, and getting listings and closing loans. And, just like it, the job itself is not how it's portrayed in real life.
No.
Your real estate agent matters.
Yeah.
It 100% can make a difference of several $1,000s. And it can make a difference of a deal blowing up or being held together. It just does. And we have buyers all the time. And it's like, my sister, that's a family member, is a real estate agent. And we'll get the contract in. It's not even completed correctly. And it's like, I'll look at Jared and tell him this is going to go sideways.
Yep.
We have somebody that has no clue what they're doing. And so we talk about syndicate and your cheerleaders and like who you work with. It 100% can make a difference between the deal getting closed and not getting closed.
It does. And before I want to touch on one more thing before we have to leave this, before we have to end our broadcast. The commercial banking system, not many people pay attention to this stuff, but I do. I'm paying attention to everything. As that continues to have issues, do you believe that that's why we're starting to see that on the residential side, that the residential banks, because banks are collapsing, and this is a problem clearly, that we're going to continue to see tightening of the guidelines? What's your projections?
I think so. But I don't think they're going to announce anything, honestly. I think they're just going to keep tightening them up till they find their mix. This is all opinion. I don't have any proof of this, but I think that's exactly what they're going to do. And I think these banks, unlike most people that are failing they've got their skis out in front of them. They took on all these bad loans. They got fat and happy over coronavirus and did all these refinances, and were holding that paper to service them, then realized they weren't making enough money, then, got into spin out. Like, these banks, they're just not, they didn't run their business smart. They were thinking of the now, not 5 years from now.
Oh, yeah.
They're going to continue to fail. I believe that. There's more banks that are going to fail in the next 6 months.
I agree.
Not the ones that were smart with their business. The banks that are failing, in my opinion, are the ones that got their skis out in front of them.
Yeah.
It's like, yeah, you got too big. And we've seen it with internet lenders. Everybody got in on the refi business.
Yep.
We have loan officers that sat behind their desk for months, didn't talk to a real estate agent, and blew those agents off.
Yeah.
And we're seeing that now. Like, where were you a year ago? You wouldn't pick up the phone. Well, they didn't pick up the phone because they were closing $3 million worth of refis. They didn't need it. Well, that party's over.
Yeah, Trisha, and I think that too, like I said, on our side, different than commercial, obviously, but it's easier to track, I think, as far as how these loans are performing, because they can see defaults and missed payments and all these things, so they can see. And I think as soon as the market turns, and like I said, inflation goes back down, rates go back down, you're going to see these loans start to perform better because rates are going to be lower, payments are going to be lower, and they're going to lessen these risk guidelines again. But until then, it's going to stay, and it might get worse before it gets better. But they make adjustments on our end pretty quick. Like Scott said, though, like I said, they don't announce it. But like, hey, we just tightened this up today. Look out for this. It's never like that. It's just like you find out down the road that we find out because we're like, shit, it's not running, and then we get a report out that they tighten guidelines up or something. So it's just, but I do believe that as the market comes back, and especially once rates fall, because when rates fall, these margins and these risk-based prices, these points that these borrowers are getting charged at closing will go away. They'll be back to no points for origination or discount, or 1 point, which would be normal, instead of 1.5 to 2.5 to 3 points. And that's what's needed more than anything for these lower FICO people.
And I know that we got to wrap this up, but when you think about it's what we call in our world, Trisha, margin compression. So when rates start to fall and someone pays a discount point, right, at a $400,000 loan, before that, your rate might go from 6 to 5.5% with that 1 point. Now it's so compressed, that 1 point might go from 6 to 5.875. So it doesn't make sense to charge the point.
No.
That's what we're seeing a lot, like explaining to borrowers, because we still get borrowers that are like, I want my rate as low as it can get. Well, it doesn't make financial sense to buy your rate to 5% and charge you 5 points or something crazy.
No.
Because you're not going to change your rate that much. Where when the margin, it's not compressed like that, 2 points, 3 points would take your rate down into the threes. It's a significant difference. Now it's like you're getting charged 2 points and your rate's going from 6.25 to 6. You know what I mean? It's like, you need to just be a par. Like, take the rate and refinance later.
Right.
One final thought from both of you guys because I always promise everybody we're going to talk about rates, because everybody's wanting to know about interest rates, and I talk about them all the time. Jared, we'll start with you. What are you thinking interest rates will do in the next 90 days?
Well, everyone was kind of hoping and praying that the Barry Habib report of May 10th was the D-Day projection that rates were going to start to tumble. And that CPI index report that came out was basically on par with what they projected. So it wasn't better than what they thought, which is why there wasn't a big rally. We saw a slight improvement, but I think that everyone's still on the fence. Is the Fed going to raise it one more time, or are they not? Because I think if they announce that they stop, we'll start to see the rallies in the market, more than we are now. You'll start to see that. And I think we're just one big report away or a couple reports away from seeing significant rallies again. We haven't had those. We had twice in September where we dipped right below 6%, and they were there for a blink of an eye, and then in the mid sixes and upper sixes. And today the national average is like 6.6%. It's up like an eighth already this week. So it's the best we can describe is the volatility is still there. We've been hovering around the 6.5 for it seems like all year, really. I believe that getting into summer, we're going to see some of those reports. And I think we do see some rallies. All we're hoping for is high fives. If you're getting the high fives, people are going to get excited. I think it's going to stimulate people to get out and start looking again. Because we think we all agree the struggle we're in is none of these conventional borrowers are listing their homes to sell because they're at 3%. They don't want to go from 3 to 6. And so we need to get that people. We need people listing their homes and going buying, and I think that'll open up. But I mean, if I had the crystal ball, I wouldn't be doing this. I'd be somewhere else right now. But no, I do believe.
What would you be doing?
I would be on the beach and anywhere but here.
A fortune teller?
But no, I do believe we're going to see some rise. I think later this year, first of next year, we're going to see a turn where I think we're going to be in a much better place.
What say you, Scott?
I think by the end of summer we're going to be back down in the fives.
I do too.
I don't think, and my issue with the rates have always been the same. We're very blessed where we live and where we do loans. Yeah, that's great that you bought a $300,000 house at 3%. But if you're going to continue to wait on that house because of the rates, you're now going to buy the home for $420,000, and the payment's going to be the same. We're just not. I mean, I travel a lot in the state of Texas, and I see this in Florida when I do loans. The market is going to continue to increase in value. So the longer you wait, the more expensive the house is going to be. So if you're payment driven, I mean, you can have a $2,000 a month payment at $350 at 3%, or you can have a $2,000 a month payment at $300,000 at 6%. Like, you're still going to. And I use my own personal. I bought my house for $300,000 3 years ago, and I could sell it for $550 without probably batting an eye right now.
Yep.
You know what I mean? And it's just where we live, values are going to continue to increase. They might not increase like they did the last 2 years, but guess what? They're still going to go up. Mm-hmm. So you can wait as long as you want for the interest rate and play that game. You're just going to pay more for the house the longer you wait.
Yeah, and give up all that equity you could have made. Insanity, you guys.
Yes.
Hey, Scott and Jared. Okay, for number one, you guys, you consumers out there, we have to wrap it up because we have to go into another thing. But if you've not caught wind, number one, they know what they're talking about, which is critical right now if you're thinking about buying a house, because there's a lot of dummies out there that don't know what they're talking about. So who you partner with matters. Number two, they're clearly not lazy. Well, I can give you testimony after testimony of the things they've done for us and with our people, because again, they don't give up. And number three, you want to run numbers, talk to these guys, because if you're a real estate agent and you don't have a lender that you can trust, you're with the wrong person. I can promise you that. Scott and Jared, how can they find y'all?
Go ahead and give your phone number.
Well, we can be reached on our cell phones. That's always the best way. Cell phone, email, text, whatever. My cell phone is 281-615-1482. My email, if you want to write down, is jaredwhite@afncorp.com. Scott, are you looking up your phone number?
Yeah, I was looking up my email because I don't know what it is, Jared.
Middleton@afncorp.com, and give them your cell phones.
936-499-0509. Call me anytime.
yeah, I'm going to tell y'all another place you're going to be able to see them in the next few days too. If you guys don't know, and if you go to Realty, not Realtor, realty.com, we have an exclusive partnership with them where all of our listings are there. We pretty much own most of the territories there. And Scott and Jared are our preferred lenders. And so they'll be all over there as well. So if you're looking to get pre-approved, looking to book a showing, realty.com is where you're going to go, and you're going to be able to get all of our info there. So make sure and look us up on there. You guys, final words. You all got it.
Hey, you have a great day, and let's close some loans.
Amen. Let's do that.
I
Call
appreciate
us.
you guys.
Thank you.
Have a great day, Trish.
Thank
You're
you.
welcome. Bye, y'all.
Bye-bye.
Bye.